What's up everyone? Welcome to Wise Wealth, where we dive into all things personal finance. Today I wanted to focus on commodities, and specifically on gold. We've heard a lot about gold lately due to its strong performance in recent months. Year to date, gold is currently up over 15%. While stock markets have languished due to the pandemic crash in February and March, gold has proved to be a resilient asset in the face of a turbulent market. In this video, we will explore why that is, what the benefits and drawbacks on investing in gold are, the ways in which we as investors can add gold to our portfolios, and finally, if gold still has some upside in the future for us to benefit from. If you're a regular viewer on the channel, then welcome back. If you're enjoying the content, then hit the like button, and if you're not subscribed, make sure to subscribe to my channel and click the notification bell to make sure you don't miss any new uploads. Without further ado, let's get into the video. So let's start off by exploring why people choose to invest in gold. Well, simply put, gold has been viewed as a currency for as long as we know, even longer than the traditional fiat monetary system we follow now. The use of gold dates back over 5,000 years ago to the ancient Egyptians, where gold signified wealth and prestige. But it's important to identify gold's primary use as an investment. Where precious metals differ from other traditional investments is that these are non-productive assets. They don't generate value for the investor throughout the time of ownership. Where a rental property will generate the investor income through tenancies, and stocks will pay out dividends to their shareholders, a kilo of gold will only still be a kilo of gold 50 years later. Throughout the time of owning the gold, the investor hasn't made any gains on their investment, except for the intrinsic value that the gold now holds, if it had gone up. So why do we elect to invest in gold? Like it has done for the past 5,000 years, gold signifies an alternative currency to our traditional monetary system. Buyers and sellers have designated a price for gold based on the simple rules of supply and demand. And where gold starts to shine is when other investments begin to dwindle. Unlike cash, which can be printed at a whim by the central bank through quantitative easing, gold is finite. Mining gold takes time and resources, so it's easier to maintain a level of circulation in the markets at any given time. So investors sometimes invest in gold to hedge against inflation, although this hasn't always proven to be particularly lucrative. Where gold becomes a strategic asset allocation in an investor's portfolio is to help build an all-weather fund, where a portfolio can perform in any market condition. This term was coined by Ray Dalio, the founder of the largest hedge fund in the world, Bridgewater Associates. If you want to learn more about macroeconomic factors that affect the markets, I don't know anyone better suited to learn from. I'd also recommend his book, Principles, for anyone interested. I'll leave a link in the description below if you want to check that out. If we look at the price chart of gold over recent history, we can see that demand for gold excels at roughly the same times other traditional investments suffer, such as stocks. This is because gold is seen as a safe haven. Having a small percentage of a total portfolio in gold or precious metals can balance out overall losses experienced when the markets start to trend downwards. Just looking at the price of gold during market recessions shows us this. Also, for further confirmation, we can compare the correlation between the price of gold and the VIX, the index that measures the volatility of the S&P 500. An investment in gold is a hedge against volatility, which is why we saw so many flock to the precious metal when uncertainty in the markets rose. But is there any potential for gold to rise any further? Or has it hit a ceiling? And will we start to see it fall again? A couple of factors suggesting that gold could rise even further are: number one, developed market currencies weakening pose a good environment for the value of gold. The historical weakening of the sterling has been halted somewhat, but should the UK fail to achieve a successful outcome from the ongoing Brexit negotiations, we could see a further weakening of the pound, which gives the opportunity for gold to thrive. Similarly, the weak dollar has been a hallmark of the current crisis. This has actually benefited those in emerging markets, and forecasts expect a weak dollar outlook to continue into the future. Number 2. Low treasury yields provide a solid indication of strong performance of gold in the future. Current 10-year treasury yields across the developed markets remain very low, giving gold the status of a strong alternative asset for capital allocation. But how do we invest in gold? What are the best ways to do this? Well, there are a couple of different ways, but each of them comes with their own benefits and drawbacks. Let's take a look at them. The first option is to simply buy gold coins or bars. These track the price of gold to the day or even the hour, so they reflect fair market value. But physically owning gold can be more expensive than you think. To store gold safely, you'll need to store gold in a vault at a bank or in a safety deposit box. Storage and insurance costs can easily mount up, cancelling out any gains you may see on your investment. And if the value falls over time, you will still incur these costs. The other option is to store the gold in your property, but that may not give you the peace of mind you need. And owning gold shouldn't be something that stresses you out. Another drawback of owning physical gold is that it's relatively difficult to liquidate when it comes time to sell it. This takes time and may not suit what a lot of investors are looking for. And the second option eliminates this concern, and that is investing in an ETC. An ETC is an exchange-traded commodity. These give investors exposure to commodities such as gold. They're traded like shares in businesses, so if you're an active investor in the equity markets, you'll be very familiar with how this works, and you can invest in ETCs through your normal investing platform. The price of the ETC fluctuates based on the underlying commodity it's tracking, so in this case, gold. Like ETFs, ETCs carry an expense ratio, where the investor incurs a percentage fee based on their capital invested. Once again, this is down to the fact that the fund manager will need to store the gold safely on behalf of the investors, which incurs a cost. I've listed a few common ETCs that track the price of gold in both the UK and the US, along with their corresponding expense ratios. It's worth remembering that the assets under management and the size of these ETCs is irrelevant, as they're tracking the same commodity. The price of the ETC will rise and fall in line with gold, all the same. As well as having many benefits, there are several drawbacks to holding gold. Firstly, gold has been known not to perform well relative to other investments over the long term. If we track the performance of gold over 25 years compared to equity investments, the gap widens with every year that gold is held. On top of this, if we factor in the reinvestment of dividends, stocks really start to outperform. This goes back to the fact that gold is a non-productive asset and doesn't work for you. This fact also determines its second negative. The value of gold, and precious metals in general, compared to other investments available, is relatively arbitrary. It's a number that's placed on the metal based on the supply and demand in the market. With other investments, such as stocks, we can robustly quantify their value by analyzing their EBITDA, levels of debt, operating margin, and other financial metrics. With real estate, we can compare the valuation of neighboring properties, estimated rental values, and much more. Since gold doesn't cash flow for us, none of these metrics can be applied. The price is simply determined by what people are willing to pay for it at any point in time. This makes many investors uneasy and choose to steer away from it. One element that can determine price of gold is its demand for jewelry. We've seen that during the crisis, demand for jewelry in India and China, the largest gold jewelry markets globally, has declined significantly. This generates a headwind for gold in an environment that it's supposed to excel in. Quite counterproductive, isn't it? I'd be really interested to hear your thoughts on this, so let me know in the comments below. What do you think of the situation surrounding gold at the moment? Do you currently have investments in gold? Thanks for tuning in today. I hope you enjoyed the video. If you found it useful, smash the like button, I'd really appreciate it. If you want to see more content like this, then subscribe to my channel and be sure to hit that bell icon to get notified when I upload new posts. I upload all sorts of videos on this channel, not just these types, so if you're interested in investing tips, top fives, and stock analysis videos and more, check out my channel. Also, be sure to follow me on Twitter as well. If there's something of interest, but I'm not thinking of making a video on it, I tend to use that as my go-to social platform. So there's more content on there for you that you may like. Thanks again, and from us at Wise Wealth, until next time, see ya.